Thanks for attending today's webinar, How to Prepare for Your Series A. I'm Shrav from Pilot. For those folks new to Pilot, Pilot puts premium bookkeeping within reach of every business. When you work with Pilot, you're paired with an expert bookkeeper in our offices, and every month they take care of updating your books. We have thousands of clients that rely on us for timely, accurate, and reliable bookkeeping. And today we have the pleasure to have Aaron Terwey from Atrium. Hey, Aaron.
Hey, Shrav, glad to be here. I'm part of Atrium's financing team, primarily representing emerging companies in venture capital financings and general corporate matters.
Aaron is going to be sharing a wealth of information today. But before we move on, Aaron, can you give our audience a quick recap on what it is that Atrium does?
Absolutely. Atrium's a full-service corporate law firm. We use modern technology to deliver legal services, and our goal is to be fast, transparent, and price predictable. We were founded by Justin Kahn, and we're backed by Andreessen Horowitz, YC, General Catalyst, and more. We're trusted by over 400 of the top startups and hyper-growth companies in and outside of Silicon Valley. A little bit about me. I've been an attorney for 7 years, representing emerging companies for 5 of those years, and been at Atrium for nearly a year and a half.
Awesome. So to go over today's agenda from legal to finance, Aaron and I will discuss 6 key components of what it takes to raise a Series A. Number 1 is setting expectations. Number 2 is making the right connections. 3 is managing the highs and lows. 4 is determining the right amount of funding. 5 is understanding the terms. And 6, knowing when it's not going to happen. We'll also have time for a Q&A afterwards. We encourage you to ask questions throughout this presentation. We'll try to sprinkle them in when applicable, and we'll make sure to answer all the questions at the end. So let's get started. Aaron, from the legal side, what should CEOs and the executive teams be aware of, primarily because seed funding and Series A are so different?
Yeah, so I think to start off, it might be beneficial for us to quickly sort of explore how the two are different, so there's an understanding of what's going to be different between the two types of rounds. So in a seed round, the paperwork is so much simpler. Investors are typically investing with safes, which are simple agreements for future equity. Those are the sort of the latest and greatest of what used to be a convertible note. And so overall, seed round will have very simple terms. There's not a lot to negotiate there. You can raise money incrementally over time. Just because you have a safe, with a say $15 million cap doesn't mean that your whole round has to be $15 million cap safes. Versus a Series A. A Series A, you have to go find a lead investor to sort of lead the round, and they're going to be the investor that you negotiate all the terms with. And so just sort of negotiating the term sheet takes a lot of time. And then once the term sheet is signed, then it takes a while to sort of hammer out the paperwork. There are 5 primary documents in a sort of equity financing, and so it's going to take a long time to hammer out the details of those documents, as well as the diligence process takes a lot longer in a Series A. So basically, to tie into setting expectations for an equity round, you're looking at from term sheet signing to closing, the initial closing, which is with your lead investor and whichever other investors are teed up and ready to go. It usually takes about 45 days from that term sheet signing to initial close. A lot of that has to do with, the diligence process. You are setting up a data room. There's going to be your legal data room as well as typically a business data room. And so the legal data room is going to have basically all of the documents that the attorney for the investor is going to want to look at and make sure that the corporation is buttoned up and as sort of in good housekeeping as it needs to be in order for the lawyer to give their blessing so that the investor can put the money in. And as I mentioned, the 5 sort of core documents for an equity financing, that's going to be the stock purchase agreement, the investor's rights agreement, the right of first refusal and co-sale agreement, and the voting agreement, along with the charter, which is the sort of the company's rule book, so to speak. And then, with the 5 documents, there's a lot more to be negotiated. And then finally, the the process itself in terms of closing. Most of the time, if you're raising an equity financing, you have a lot of safes that are converting into that round, and with that means you have to go track all those people down and ask them to sign these documents. So, trying to track down, say, 30 or 40 people when they might be on vacation or they might be hiking the Appalachian Trail. Who knows? It's going to be hard to get these people to all sign documents at the same time. Then also, like I mentioned, the diligence process. That's one of the areas where, I think that founders can, do a lot of the legwork early on before you get a term sheet and sort of help shortcut that 45-day process. And so just, getting the, the documents in order, making sure that, documents you need to have signed actually have signatures. And that just, not only from, the counterparty, but from the company side, make sure the company has signed the documents that they need to sign. So yeah, that's how I would set expectations.
Mm-hmm. Got it. So from the business and financial side, I would also add that it's important for founders to have the right narrative, pitch, and connections. Like, you really want to know what you have to say, have your financial data in order, and know who you want to speak with.
Yeah, I agree on all points. Our CEO, Justin Kahn, has a great blog post that highlights the importance of the investor pitch. It's definitely worth checking out.
Definitely. So, Aaron, speaking of Justin, his thoughts on setting up VC meetings is that most founders should go wider and talk to 10 to 20 partners, whereas some people think you should talk to only the few best investors in your space. And his reasoning was twofold. You can use the people that you want to raise from least as additional practice, or to have a bad or neutral option is better than having no option. And the way to maximize the chance of that is by increasing your funnel. Aaron, do you have any thoughts to this approach or tidbits about how companies can go about making the right connections? Like, what approach or approaches have you seen work best? Should the companies always be pitching to A-team investors?
Yeah, so it's good to have opportunities to practice your pitch in a real setting. More is definitely not bad. But you should have that sort of set of top tier investors in your mind, and I would say schedule them towards the end of your blitz, so that you've been able to sort of evolve your pitch based on that feedback. Incorporate criticisms as well as positive feedback, and then also if you know who your top tier investors are, who you really want to target, maybe some of those early meetings might have turned into a situation where you have a term sheet. And if you have a term sheet, that's some good leverage when you're going in to talk to the investors that you're really interested in. Having a certain amount of buzz helps motivate people to take action. We've also recently pulled together a helpful tool to track your investor research and engagement process. It's definitely a time-consuming process, and we thought that bringing together in one spreadsheet would be helpful for our founders.
Right. It sounds like that's pretty tedious and frustrating. Like, what are some areas of the fundraising roller coaster that folks should be aware of, specifically from the legal side of things? What can companies do to navigate some of these challenges? Or what are some of the legal challenges CEOs will generally come across?
Yeah, so one of the biggest, fundraising, I don't want to say it's a mistake, it's a cautionary tale, is making sure that you have sufficient cash runway to provide flexibility in the fundraising process. You definitely don't want to be in a position where your back is up against the wall. You're negotiating, a financing, but you also know in the back of your mind, hey, I'm running out of money. So, even if this investor throws some very unfavorable company terms at me, I need to take it because otherwise I'm going to run out of money. So, make sure, it's not just having the money to take you to the beginning of the fundraising process. You need to have it so it takes you all the way through the end of the fundraising process, and in an ideal situation, even beyond, because there will be unexpected delays in the fundraising process. I know I mentioned, our median time from term sheet signing until initial closing is about 45 days. But that is a median. There are financings that take much less time, but there are also financings that take much longer amount of time. So yeah, runway is definitely negotiating leverage, and you want to make sure that you have that sort of buttoned up. You also need to sort of have achieved the milestones necessary to get the valuation that you think you deserve. Nothing is certain in this world, but if you have told your seed investors, hey, I'm going to raise this money from you guys, and then I'm going to go out and do X, Y, and Z with it. Well, if you haven't done any of the things that you said you're going to do, that's not a good look. And just make sure that your revenue goals are where they need to be in order to justify the valuation that you're seeking. We talked about it earlier. Make sure that you're thoroughly prepared to deliver a knockout pitch and efficiently respond to diligence requests. Know your company's numbers. I'm sure we've all watched Shark Tank, and there's nothing for me that's more embarrassing than seeing a founder get up there and, Mark Cuban asks them, okay, well, what's your revenue to date? And they don't know. So be sure you know your numbers. It goes to show how involved and how dedicated you are in your business. Now, I get it. We're not all numbers people. I'm a lawyer. Lawyers are notoriously not numbers people. But you can have a set of numbers that hey, they're going to ask me about revenue. They're going to ask me about customer acquisition costs. They're going to ask me about, X, Y, and Z numbers. Have those numbers. And maybe they ask you a number that you don't know. Find a way to sort of pivot that into one of the numbers that you do know. Finally, I would say be prepared for rejection. I can tell you from personal experience, I am not very good at handling rejection. But if I sort of tell myself, okay, I'm going to walk into this meeting and I'm going to be rejected. Obviously you don't want to go in with a negative mindset, but if you prepare yourself for the worst and hope for the best, then, if you walk out and, they say, great, let's set up another time to talk, that's a pretty good sign. But if you are going into every meeting thinking that you're going to walk out with a term sheet, it might sting a little bit more. So, the no's can hit you hard, but just be prepared for it and know that, the right investor is out there somewhere.
Definitely. So when it comes to determining the right amount of funding, well, actually, I feel like this is a hot topic right now because of the sensitivities to dilution. I know many companies will see what other like-minded companies raise and mirror that, but you really need to be strategic in figuring out the right amount of capital you raise. You need enough money that provides you an adequate cushion to get to the next set of milestones and valuation inflection points. So, Aaron, what's the worst case about raising too much money, and what do you think is like the sweet spot?
Yeah. So the biggest thing I will say on this is the money that you're raising today is going to be, so to speak, more expensive than the money that you raise in 12 months or 18 months from now, just because you're dealing with probably a lower valuation today. So, a dollar that you take from an investor today is going to be more dilutive than a dollar that you might take in 18 months from an investor. So, yes, dilution is a very hot topic right now, but, this is all going to make sure that you are not raising too much money. And I can't tell you, how much is too much money for your business. But, the risk of the dilution in a round is the risk of losing control of your company earlier. I'll also say that, companies, generally speaking, the more you raise, the more you tend to spend. If you have a very flush bank account, maybe getting this new office space that is flashy and has all these really cool built-in features, you might be more inclined to spend on that versus if you stay lean and you're a little hungrier, you might sort of say, okay, you know what, this sort of older office space, it's not that bad. We can deal with this. And so in terms of the sweet spot for raising money, I would say give yourself 12 to 18 months of runway, as and I want to say 12 to 18 months based off of what you think your spend will be after the round. Your spend before the round is going to be significantly less, because as you go out and raise money, then you'll use that money to, like I said, get new office space or maybe hire new people. And so, calculate what you think your burn rate's going to be after the financing, and then, sort of use that to calculate your 12 to 18 months worth of runway.
Awesome. So when it comes to understanding the terms, what due diligence can CEOs do beforehand? What's the pre-paperwork that no one's really thinking about?
Yeah, so I think there are 5 things that CEOs should keep in mind before the term sheet. And these are really things that CEOs should do at the very beginning of the fundraising process. Number one is I would sort of, figure out what's important to the company and what's important to you as a founder, and clearly understand where you want to go with your company. I say this because negotiations are going to be a give and take process. There might be certain key terms in a term sheet that are really important to you, and other terms that aren't so important. There might be some of the terms that aren't so important to you are very important to the investor. And so, if you sort of have in your mind, what your dream term sheet looks like, as well as terms you would absolutely never accept, and sort of also find a place in the middle, you say, okay, well, if they're asking for, this, then I know I'm going to say, okay, well, then I want that. So just make sure you have in your mind what's important to you and, where you want the company to go. Next, I would say, related to that is, having an understanding of what all the terms in a term sheet mean. You don't have to be able to recite what the formula for broad-based weighted average anti-dilution is off the top of your head, but generally have an understanding of what the different anti-dilution calculations are and how they work. I'll tell you right off the bat, for anti-dilution, it is all generally broad-based weighted average anti-dilution. So, you don't have to spend as much time being familiar with that, but, it's good to know, what aspects of operational control of the company are important to you, and also, what aspects of the financial terms of a term sheet are important to you. Number 3, I would say is deadlines. We all have a tendency to get anxious and panicky about deadlines. What I will say is that most of the deadlines imposed by investors are fake. And I'm not, trying to insult investors. I'm just saying, if you want to get somebody to act, you put an end date on it. You say, okay, I need to know by July 11th whether you're going to accept this term sheet. Chances are, if an investor has taken the time to draft a term sheet and send it to you, and they have put a deadline on it, yes, you want to be respectful of their ask to have a response within a certain amount of time, but also understand that if you have a meeting coming up with, your dream investor, obviously don't tell the investor that gave you a term sheet that they're not your dream investor, but say, hey, look, I really appreciate having this term sheet from you, and I recognize that you said July 11th was the cutoff date. I have some additional meetings set up. I was wondering if we can sort of extend that to, say, July 15th. Most of the time, if they've given you a term sheet, they are more than willing to accommodate your extension request. This is the beginning of a very long relationship with these investors, and so they, at the outset, they want to appear as accommodating as possible. And so, asking for an extension on a deadline isn't going to make or break their fund. I will say this also: your investors, particularly lead investors, are the only partners that you can't fire. Obviously, if you have, 2 other co-founders, you can't really fire them, but, you can find a way to part with them. Investors, it's much harder. Typically, a Series A investor will have a board seat. And so just know that, you want to be respectful of their deadlines, but they also, you want to be able to push back and also be able to still operate a business with them. Number 4, I would say, is having a good timeline of communications. So when you're teeing up a Series A closing or any equity closing, there are a lot of people that have to sign documents, particularly if you have safes that are converting. So you need to be able to communicate with your current investors about the next round, about all of the people that are involved, but it's also a good idea to set expectations as to timing with these investors. When we are working through a financing and we know we need to collect a bunch of signatures from safe holders, we don't send the documents to them until they're final with the lead investor, because we're trying to expedite the process as much as possible. So to the extent that we send documents too early and documents change throughout the process, then we have to resend those to safe holders. So what we tend to do is we just say, okay, great. CEO, let the investors know that you've signed a term sheet, and then let the investors also know that you'll be sending them or will be sending them the documents as soon as they're final. And then once the documents are final, we try to give safe holders about a week to review the documents and collect their signatures. So just be aware of those sort of headaches. Also, if you let them know earlier in the process, I mentioned, sometimes people travel and go out of the country and go to places that don't have, cell phone signal. So to the extent that you can let these investors know early on that, hey, here's our anticipated closing, they can say, oh, I'm going to be on this huge trip. And you can know, okay, we need to get them documents sooner so that they can execute before they leave. And then 5th and final, I would say, legal housekeeping. Make sure that you have confidential information and inventions assignment agreements signed with all of your employees. Make sure all of your employees have signed employment documents. Make sure that everybody has filed an 83B election on time. Make sure that you have a scrubbed and clean cap table. There are little things that you can do that are just good practice for running a company. I recognize that it's not the exciting part of running a company. That's the exciting part of running a company is developing product and writing code and launching new services. But if you want to be able to get your company to that next step, one of the unfortunate requirements is that you have a clean legal house, so to speak.
Totally agree. So what terms should founders be wary of? What are the definite red flags from both the company and the investor?
Yeah, so I will caveat this with, this is, the sort of true venture financing red flags. Obviously, if your company's in a different position where you're looking at more of a private equity type investment or more of an operating partner investment, that this is not the case. But for true venture financings, I would say big red flags for me are if an investor is asking for participating preferred stock. To briefly sort of explain what that is, most preferred stock, the liquidation preference is a non-participating preferred. Non-participating preferred, the more common of the two, is basically downside protection. It says that the investor gets the greater of their original investment or participates pro rata with common in the event of a liquidation scenario. Participating preferred is more of a double dipping scenario where they get their original investment back and then they share pro rata with common. So participating preferred is a red flag. Full ratchet anti-dilution, I mentioned earlier, broad-based weighted average anti-dilution. Full ratchet is a huge red flag. I will not get into trying to explain that right now because, I don't want to take up all of your time and I would like to not have you fall asleep on me. And third, I would say founder reps and warranties. I will say founder reps and warranties are much more common from European VCs. I see that, regularly from European VCs. but in the Bay Area, and I'd say in the U.S. generally, for venture financings, founder reps and warranties are a huge red flag. And to sort of explain what that means briefly, in the stock purchase agreement, when the company is selling stock to the investor, there are a number of things that the company reps and warrants to. What that means is the company says, hey, these things are true. This is what our capitalization looks like. We own all the intellectual property we need to operate the business. We haven't been sued. All of our employees have signed, employment documents. Those are all the standard, there are a lot of standard sort of company reps and warranties. Where you start to run into the red flags is when the investor is asking the founders to say, yes, as the founder, I promise that the company owns all of the IP that it needs to own. Well, no. That should be a rep and warranty that the company makes. This goes back to sort of, the nature of corporations and the limited liability effect of them. Companies are designed to have limited liability for the people that own the company as well as the people that operate the company. Once you start introducing founder reps and warranties, that sort of blows up the limited liability protection of the company for the financing.
So I've heard it's fairly common for investors to go dark because no one wants to tell you no, because in the future they might want to invest. So from the legal standpoint, what are the red flags? Like, when do you tell companies to step back? Yeah,
so Steve Huffman, who's the Reddit CEO, said in his Scale fireside chat that your deals are going to look like deals fast, and the non-deals, well, they never look like deals. Focus on finding the right chemistry between you and the investor. Basically, with that said, if you aren't hearing back from investors, they aren't interested and you can move on. If they've given you a term sheet, they are interested. And going back to the deadlines discussion we had earlier, they should be willing to wait and be flexible with you as you sort of navigate this pitch and fundraising process. In terms of red flags from the investor perspective, versus the terms perspective, look out for overly pushy or aggressive investors. The investor that says, absolutely not, you can't have an extension on this deadline. I need to know, tomorrow whether you're going to accept this term sheet. Now, if this is the term sheet that you've had for a month and you keep asking for extensions on, the drop dead date, then yeah, that's a little more reasonable. But if they just sent you the term sheet yesterday and want to know tomorrow whether or not you're going to take it, that's a red flag. They should be comfortable with the strength of their term sheet and not have to resort to sort of pushy or aggressive tactics to get you to accept their term sheet. Sort of related to that, I would say do your own due diligence on the investors. Ask for the names of founders they've invested in, and reach out to them and talk to them about how investor X has been as a partner. And then beyond the names that the investor gives you, I would try to find companies that they've invested in that they haven't given you the names of, or maybe an investor, or a company that maybe the investor has invested in where the company has failed. It would be very interesting to me as a founder to know how that investor behaved when things weren't going as well as they had planned.
So on that note, Aaron, we've had a few questions come in from our audience, so we can move on to the Q&A portion. And so it looks like the first question is like, how long should you try to raise a Series A before you give up?
I guess it really depends on how much runway you have and how committed to the endeavor are you. It's one of those things where I can't tell you that if you've been out pitching for 6 months and you haven't gotten a term sheet, then you should give up. But I don't know that there is a sweet spot. That's going to be a sort of a gut call by the founder.
Mm-hmm. Got it. So the next question we have is, do you have any favorite tools to manage cap tables? We've been liking captable.io a lot. Anything else we should check out?
I would say my favorite, and it's definitely not the lower cost resource of cap table management tools, is Carta. I find Carta to be very useful in terms of, being able to see all of the equity that's outstanding, and all of the modeling scenarios, et cetera, et cetera. But yeah, captable.io is very useful as well.
Yeah, definitely. We're huge fans of Carta at Pilot. So the next question we have is, what due diligence or reference checking would you do on an angel who is putting in $10,000 to $20,000?
Yeah, I mean, do a certain amount of due diligence. Obviously, as a founder, you can't spend, the entirety of your day doing diligence on every $10,000 to $20,000 angel that's putting money into your company. But at the same time, you do want to be mindful of the fact that you can't really fire investors. If you take $10,000 from an investor and they turn out to be a huge pain, you can try to negotiate a buyout. You can try to negotiate, hey, you invested $10,000. What would you accept in order to sell your company back or sell your equity back to the company? Talk to, if they are an active angel and they've invested in lots of companies, again, ask for companies they've invested in and try to talk to those founders.
Mm-hmm. Could you touch a bit on raising multiple YC safes at like the pre-seed or seed stage?
So I assume that by multiple YC safes, the question refers to, the YC safe template. That is a very common seed capital raising tool. I would say of the equity financings that I work on, 90 to 95% of them have safes that are converting into the round, and they are, the standard YC safes.
Mm-hmm. So another question that's come in is, I've heard from lawyers that seed and Series A investors will always push their vesting terms onto founders. How non-negotiable is this in reality?
Yeah, so I wouldn't say it's non-negotiable. I would always push back if I'm representing a company there. So to break it down a little bit, standard vesting for startups is 4-year vesting with a 1-year cliff. What that means is that no equity vests until the person has worked at the company for a year, and then after that, it's a monthly for 36 months until all of the equity is vested. Founder vesting, it's complicated because a lot of times founders don't vest their equity at the outset. They might come into an equity financing and never have subjected any of their equity to vesting, and now you have an investor coming in and saying, well, we don't want to put a bunch of money into a company where then all of a sudden the founder could turn around and walk away with all of their equity. So it's not an unreasonable ask for the founders to revest their equity. What I would be, skeptical of is a request from an investor to basically revert back to full unvested. So, if the investor says, okay, great, as of the initial closing, none of your equity will be vested, and after a year, then you vest 25%, and then it's monthly thereafter. Well, no. Let's step back and look at how long have these founders been working on the company. If the company's been around for 2 years, okay, well, let's say, and they don't have any vesting currently in place, let's try to go with, okay, great. We'll start with half of the founder equity being vested and the remaining vesting over the next 24 months. If that's not going to be enough for the investor, I'm fine saying, okay, fine, we'll settle with a quarter of the equity being vested and the remaining 75% vesting over the next 3 years. It's a give and take. I don't get offended when I see investors asking for founder revesting. If they're asking for full revesting, I take a little bit of an issue with that. But for the most part, I see these founder revesting requests to be quite reasonable.
Got it. So what is the typical percentage that investors ask for in a price seed round versus a price Series A?
Typical percent. I don't know that I can give you a typical percent. I would say, I would say that on average, I would say on average, a price round will be, between 20 to 30, sometimes 40%, being sold. Obviously the lower the better. Again, as the percentage of the company that's being sold in the round increases, you have to start worrying more about founders losing control of the company. So, what I would say is there isn't a standard that it's, if you made me tell you, hey, give me percentages, I'd say, a typical Series A is 25%. Equity seed rounds, we do them here at Atrium. We don't do a lot of them. Most of the time we're seeing the seed rounds be done through safes. But I would think that an equity seed round would be a slightly lower percentage.
Mm-hmm. Do you think a founder should be able to take a salary before or after the Series A?
Yes, absolutely. I think, this is San Francisco. We can't live for free here. So, I would absolutely think, okay, is it going to be what your salary would be in a comparable industry or in the same industry in a comparable role at a, Fortune 500 company? No, but I think that founders should absolutely be taking a salary. It should be reasonable. It shouldn't be, if you're going out and raising, at say a $50 million valuation, your salary probably shouldn't be $1 million a year, but, just be reasonable with your salary. And I think absolutely you can take a salary.
Couldn't agree more. We have a term sheet signed by both parties, but the lead investor is taking his time. How do you create a compelling event to expedite the funding?
Yeah. So, term sheets typically have a exclusivity period, which is a period after signing the term sheet that, the company can't go out and solicit other investments from other lead investors. Typically that exclusivity period is 30, maybe 45 days. If your term sheet has an exclusivity period detailed, then I would say, that would be good leverage to sort of say, okay, investor, I might be, we're approaching the end of the exclusivity period, and that might be a little motivating factor.
Got it. So in order to ask for enough and not too much, what is the best way to determine a particular investor's appetite as to how much to decide to ask for?
Okay. So I think the question there is, how do you gauge what size of investment a particular investor is willing to cut a check for? Honestly, I would ask them. These investors are not shy with saying, okay, our check size needs to be at least, $5 million, or our check size, sometimes we go as low as, $1 million. But that's, I think that's a frank conversation that you can have.
Got it. So do you need a Form D to raise capital among the generally accredited public?
Do you need a Form D? Without sort of getting into the weeds on securities regulation, I would say, okay, I'll take a step back. Regulation D is the securities law that allows for private sales of securities. If you are raising under Regulation D, a Form D is required. But Regulation D is just a safe harbor under, I believe, 4A2 of the Securities Act. And under 4A2, you don't need to, 4A2 is a much broader subset under which Reg D is promulgated. And so if you're raising under Reg D, then I think Reg D requires that you file a Form D, but not all private placements of securities need to be raised under Reg D. You can do a general 4A2 a general 4A2 offering that involves no public offering of securities.
Awesome. Well, thanks for taking the time for attending this webinar. We're really excited to have everyone. That is going to be a wrap. If you have any additional questions, we'll be able to answer them over email. Thank you.
Thank you.